What if I told you that the real secret to building long-term wealth is not finding the next hot stock, but owning boring, powerful businesses that never stop paying you? Most people in the market chase excitement. They look for sudden 10x opportunities, meme stocks, or trending tech names. But the truth is, most of those stories don't last. They rise fast and often fall just as fast. Real wealth is usually built in a much quieter way. It comes from owning companies that make money consistently, year after year, regardless of what the economy is doing. Companies that don't depend on hype, but on real demand from real people. This is where dividend investing becomes powerful, because dividend stocks are not just about price movement. They're about cash flow, real money that gets paid to you simply for holding shares. Now, think about this from a human mindset. Most people work for income. They trade time for money. If they stop working, income stops. But dividend investing slowly flips that structure. It builds a system where your money starts working for you. At first, it feels small, maybe a few dollars, then a few more, then starts growing silently in the background. And the most powerful part is not the amount you earn in the beginning. It's the direction it moves over time. If you're new here, make sure to subscribe and turn on the notification bell, okay? Now, let's start with one of the most stable examples in the market. Number 1, Johnson & Johnson. When investors talk about forever stocks, they're talking about companies like this. Not because it is exciting, but because it is consistent. It operates in healthcare, which is one of the most essential industries in the world. Now, think logically. People don't stop needing medicine during a recession. They don't stop going to hospitals because the stock market is down. This creates a type of demand that is far more stable than many other industries. That stability is what supports long-term dividends. But here is something most beginners misunderstand. A strong dividend stock is not just about paying money today. It's about being able to continue paying tomorrow and 10 years from now. That requires something deeper: strong cash flow, strong business structure, and the ability to survive change. Johnson & Johnson has survived multiple economic cycles, market crashes, inflation periods, and global disruptions. Not because it is lucky, but because healthcare demand is persistent. Now, let's shift mindset for a moment. Ask yourself this. Would you rather own a flashy stock that doubles quickly but disappears in a few years, or a slow, stable company that quietly grows and pays you for decades? Most people emotionally prefer excitement. But financially, stability usually wins over time. That is the gap between short-term thinking and long-term wealth thinking. Dividend investing rewards patience. It rewards discipline. It rewards people who can ignore noise and focus on fundamentals. And here's another important concept. Dividends are not just income. They are a signal. When a company pays consistent dividends, it is basically telling the market, we are generating enough real profit that we can share it with shareholders. That signal matters more than most people realize. Because in the long run, businesses that generate real cash tend to survive, and businesses that rely only on hype often fade. But even strong companies are not risk-free. Markets change. Regulations change. New competitors enter. Even the strongest companies face pressure. That's why smart investors never depend on a single stock. They think in systems, not bets. Now let's zoom out. The goal of dividend investing is not to get rich overnight. It is to slowly build a financial structure where your investments start generating income independently of your daily effort. At first, it feels slow, almost too slow, but this is where human psychology becomes important. Most people quit too early because they don't see fast results. They underestimate compounding because it starts quietly. But compounding is not supposed to feel powerful in the beginning. It becomes powerful after time. And that is exactly why dividend investing works for patient investors, but fails for impatient ones. Now, as we move forward in this video, we're going to explore more companies that follow this same principle. Businesses that are not built for hype, but built for long-term income generation. Some are in consumer goods. Some are in technology. Some are in essential services. But all of them share one thing in common. They reward patience more than speculation. And as we continue, you will see how each company represents a different pillar of long-term wealth building. Because at the end of the day, investing is not just about money. It's about mindset. And the right mindset can completely change your financial future. Number 4, Procter & Gamble. This is one of the most powerful consumer goods companies in the world. Think about your daily routine. Toothpaste, soap, shampoo, detergent, cleaning products. There's a very high chance you use something from this company today without even noticing it. And this is where the real strength comes in. Because investing is not only about growth, it is about repetition. When a company sells essential products that people use every single day, demand becomes extremely stable. Even during economic crises, people don't stop brushing their teeth or cleaning their homes. That is why companies like Procter & Gamble can generate consistent cash flow year after year. Now, think from a human mindset perspective. Most beginners ignore companies like this because they feel too normal. They expect excitement. They expect fast growth. But wealth is often built from boring, repeated, predictable systems. A company that sells billions of small essential products across the world often becomes more stable than a company selling one high-end product. And that stability is what supports long-term dividends. Still, no investment is risk-free. Competition, rising costs, and changing consumer habits can always create pressure. But the key idea is resilience, the ability to survive and keep generating cash over decades. That is why many long-term investors quietly hold this kind of stock for years without much attention. Number 3, Microsoft. Now, we move into a completely different world. This is not a traditional dividend stock in the old sense. This is a modern global technology giant. Microsoft. Now here's something interesting. Many people think, isn't Microsoft a growth stock? And yes, it is. But today's dividend investing world is changing. Some of the strongest dividend companies are also strong growth companies. Microsoft is a perfect example of that shift. It operates in cloud computing, enterprise software, AI tools, and digital infrastructure. And here is the key point. Millions of businesses around the world depend on Microsoft systems every single day. That means Microsoft is not just selling software. It is embedded into the global economy. And when a company becomes that deeply embedded, its revenue becomes sticky. Sticky revenue means customers don't easily leave. And sticky revenue leads to stable profits. And stable profits support consistent dividend growth. Now let's talk about human mindset again. Most investors miss companies like this because they feel it is already too big. They think, I missed it. But long-term thinking asks a different question. Not, did I miss it? But, is this company still becoming more important in the future? And in Microsoft's case, the answer is yes. Because as the world becomes more digital, cloud systems and AI-driven tools are not optional anymore. They are essential. That creates long-term demand instead of short-term hype. Another important point is dividend growth. Some companies don't just pay dividends, they increase them over time. And that slow increase can become extremely powerful when held for many years. Microsoft continues to grow its dividend while also expanding its business. But remember, even strong companies are not risk-free. Technology changes fast. Competition is constant. Regulation can shift. That is why smart investors don't blindly trust a company. They continuously observe it. Number 2, Coca-Cola. This is one of the most iconic dividend companies in the entire world. Coca-Cola. Now, before you think this is just a soft drink company, pause for a moment and look deeper. This is not just a beverage business. It is a global distribution machine. Its products are sold in more than 200 countries. From small shops in villages to large cities, Coca-Cola products are everywhere. And here is the powerful idea. When a product becomes part of global culture, it becomes extremely difficult to replace. People don't just drink Coca-Cola because they need it. They drink it because it is familiar. And familiarity is a very strong force in consumer behavior. Now let's think from a dividend mindset. Coca-Cola generates massive cash flow from simple, repeat purchases. A small product bought billions of times again and again. That repetition creates stability. And stability supports dividends. Now here is the human psychology part. Most people underestimate companies like this because they think it's just a drink. How much can it grow? But investing is not about how complex a product is. It is about how often people buy it. And Coca-Cola is bought every single day across the world. Another important point is brand power. Strong brands reduce risk. Because even during tough economic periods, people still choose familiar brands they trust. But no company is perfect. Health concerns, changing consumer preferences, and rising competition in beverages can always create challenges. That's why long-term investors don't just rely on history. They also monitor change. Still, Coca-Cola remains one of the most stable dividend-paying businesses in the world. And that stability is why it belongs on this list. Number 1. PepsiCo. Now we arrive at the final stock. And interestingly, it is very closely related to the previous one, PepsiCo. But this is not just a beverage company. This is a combined food and beverage empire. It owns snacks, chips, drinks, and global food brands that people consume daily. Now here is where it becomes very interesting. If Coca-Cola is about drinks, PepsiCo is about lifestyle consumption. Because PepsiCo products are not occasional. They are habitual. People don't think deeply before buying snacks or drinks in daily life. They just do it. And that creates a powerful demand cycle. Now, think from a long-term dividend mindset. A strong dividend company is not just about current yield. It is about future cash generation. PepsiCo has something very powerful. Heavy checkmark global distribution, heavy checkmark strong brand portfolio, heavy checkmark consistent consumer demand, heavy checkmark pricing power. Pricing power is very important. Because when costs rise, companies with pricing power can adjust prices without losing customers easily. That protects profits. And protected profits support dividends. Now let's talk about human behavior. Most investors make one big mistake. They chase excitement. But wealth is usually built in the opposite direction. Boring, repetitive, predictable systems. PepsiCo is exactly that type of system. It sells products people don't overthink. That simplicity is what makes it powerful. Now here is the final mindset lesson of this entire video. Dividend investing is not about picking perfect stocks. It is about building a portfolio of businesses that can survive different economic conditions. Some will grow faster, some will grow slower. But the goal is stability over decades. Because time is the most powerful force in investing. That's all. Thanks for watching.